Welcome to Kaiser Watch with John Kaiser. I'm your host, Jim Goddard. Welcome back to Kaiser Watch, John.
Jim, pleasure to be back.
What were the two conferences like in Vancouver that you attended this week?
The Metals Investor Forum, which I attended on Sunday and Monday, had a pretty good turnout, and it had a good vibe. I did my presentation on Sunday, and of course it's not yet a packed audience. The hall was about 2/3 full, but it was a very good experience. People were happy to be back in person, interacting, saying hi to people. You had to be cautious because COVID is on an upsurge again. It was amazing how many people that I knew had managed to recently catch COVID. Most of these people are vaxxers, so all they said was, it was like a crappy cold and an annoying type thing. But the Cambridge show, which I went to on Tuesday, that was different, and it's a matter of scale. The Metals Investor Forum is in the main sort of hall area of the Rosewood Hotel, so the small space made it feel good. The giant cavern of the Vancouver Convention Center, that was too big, too much for this stage of coming out of our COVID pandemic. So the 250 companies did not have a lot of people to deal with. I paid my $39, got in, but oddly, they did not give any of the delegates a name tag. You just walked in and that was it. And even some of the exhibitors, they had tags that simply had their names on it in felt pens. So I'm not sure what went wrong, but normally it's convenient that people don't know who I am. But in this case, I had a hit list of about 45 companies, some of whose management I'd never known. So I had to go up to them and introduce myself and get them to pay attention. And that ended up working out. But it was interesting. I bumped into Bob Lamond, and he's sort of a real researcher. He loves bottom fishing, and he was saying, "This is great. There's nobody here. This is a sign to buy these juniors." And I agree with him wholeheartedly. And I ended up giving a good explanation of it in a talk. I wasn't supposed to be speaking at the Cambridge show, but Anna Sarum of the Canadian Stock Exchange had scheduled Dave Elliott, who's a partner and broker at Haywood, to do sort of a 20-minute talk about why Canada is a good destination for resource juniors. And on Friday, just as I'm about to head out to the airport, I get a call from her and say, David just caught COVID. Can you stand in for him? And I said, sure. And she'd also called Gwen Preston, who was also at the MIF conference, and she also agreed. So we were going to tag team this session. And then I find out as I show up on Tuesday that Gwen has managed to get nailed by an old-fashioned cold, which is what everybody is now once again catching. So I ended up doing the 20-minute session myself with Anna, talking about why I think resource juniors are going to boom big time right now, and why Canada is one place where they're definitely going to boom.
Why do you think Canada is a good destination for resource juniors, and why do you think this is a good time to buy them?
Okay, well, let me answer that second part of that first. The mood was kind of gloomy in the last couple of weeks because, we've seen the S&P decline 18% from its peak at the end of last year. We've seen the Dow decline 15%. It's got maybe a couple percent more to go, where it's even with its peak before the COVID pandemic broke out. And of course, some of these other stocks like Amazon have really pulled back sharply, and the whole sort of COVID boom is being unwound. But we have the scenario that a decade of quantitative easing that goosed the biggest bull market ever is also in the process of winding down. So there's a scenario now where, in addition to a recession coming as everything cools down in response to higher interest rates, we will also see stagflation set in, where the inflation rate persists, but economic growth stalls and goes nowhere. And the market has been selling off the juniors because, they're seeing metal prices retreat somewhat as speculators exit, exit those positions in the face of all these other general markets retreating. And of course, with the bond market falling as interest rates rise, that becomes an excuse to also sell off resource stocks or general equities, because obviously when interest rates are high, the bond prices will be low, so you buy the bonds and don't own the equities, because the equities growth projections have disappeared. It's just going to be modest growth potential. So the whole logic's in place for a major pullback in general equity markets, and the juniors have simply been washed out along with everything else. But while I think the bigger general equities will not have a comeback rally anytime soon, I think the resource juniors have a special time coming. And the reason is that the major producers have shifted into a sort of a self-perceived sunset mature type of sector mode. For the past 5-6 years, they have not been spending a lot of CapEx. They overdid it in response to the China super cycle. But in the last 5-6 years, they have been dialing it back. And of course, they've been having to listen to all the NIMBY crowd and ESG people complain and say, you are dirty, we don't need mining, we should go away, we should just recycle stuff. And so they said, okay, well, we won't spend any more CapEx. And Wall Street's yelling at us also, stop wasting money on CapEx. And internally, they're thinking, well, we can tell from the numbers that even if it's just modest macroeconomic growth, and we don't even take into account the energy transition with its new demand for copper and all that, there are going to be supply deficits down the road. And what happens? Well, the metal prices are going to go up. And we've got our sunk CapEx costs, and yes, inflation will pull up OpEx a bit. But in a scenario like this, we will make an awful lot of money, and we will spend it on dividends and share buybacks and just sort of flow the cash back to our shareholders. So it's this mindset of the majors which is contributing to this looming deficit in the world of physical material. Now, the juniors come into play because for the majors, you expect that in a few years they'll wake up and say, oh, I guess we should start spending money on new deposits. But the majors, they need world-class deposits. And for the past 20 years, the resource junior sector has been haunted by big is beautiful. And that worked during the China super cycle because it was the juniors, when the third world frontiers opened up after the collapse of communism, who zoomed into all these places in Latin America and Africa, picked up these deposits that were never developed because they maybe didn't have quite the right grade. But with the real price increases that the China super cycle delivered, these were in the money and they were also large. So the juniors participated to a large degree in this big is beautiful phenomenon. And most of these projects are now owned by majors. Some have been developed. Some are sitting there waiting for the right circumstances, and some are gummed up because there's some sort of a social license or environmental problem in the way. So the reason I think that juniors are going to make a comeback, a very big comeback, and that Canada is a key destination for them, is that we're switching from big is beautiful to small is beautiful. You're going to have to make up this looming deficit by finding and developing small to medium-sized deposits that range from high grade for the smaller ones to medium grade for the medium-sized ones. And the majors aren't interested in that because it takes almost as much effort to, permit and develop one of those as a much bigger deposit. But the juniors, they're able to go out there and look at all these former districts, rethink them, go into these trends, and this is where the whole lithium situation is a paradigm case for the whole sector. And it's an important paradigm case because right now there is a new investor audience of younger people who entered the speculative markets in the wake of the COVID pandemic, and for whom the trend is, my friend, momentum gambling, short-term momentum gambling. That worked beautifully. Now they're being blown out of the water A lot of them are saying, I'm never going to do this again. But not everybody is going to be wiped out. A lot have pulled out money, are sitting back, and they're ready for something called what I call slow gambling, which is what the resource juniors deliver, because everything comes in stages. You have a drill program that takes 3 months. You wait another 3 months for the assay, find out what it is, do what's next. It's not a momentum game, and it's certainly not winner take all, where an Amazon's going to own the entire online sales system, or Tesla's going to be the only car maker ultimately selling electric vehicles. So these younger investors, insofar as they're still interested in making money, speculating on stocks, we need to attract them into this resource junior sector. And that's where the lithium supply problem that's looming is going to be the gateway that pulls them into this market. Because it's projected that if electric cars are going to replace internal combustion engines by 2035, we need 10 times more lithium supply than we have right now. Where is it going to come from? Well, part of it will come from the brines. Some of it's already coming from the Australian pegmatites. But where's the rest going to come from? And it's got to be at a lithium carbonate price that isn't what it's recently been, $30, $35 a pound, because that's just too expensive to make an electric vehicle affordable for the masses. So it has to be down there at $10 to $15 a pound. And pegmatites were found decades and decades ago. Nobody needed lithium except for glassware. Then they needed some for the cell phones and the laptop batteries. But it's only in the last 5 years that a large volume has been needed for the lithium-ion batteries that go into electric vehicles. So Canada is a place that's different from Australia because it's covered in moss, swamp, bush, glaciated terrains with overburden everywhere, whereas Australia is kind of a barren wasteland where you fly over it and you can see all kinds of interesting color anomalies, and pegmatites stand out pretty visually if they're not obscured by something else. So there's now this boom happening where all these pegmatite trends are being revisited by juniors, and it's this collective action, probably end up being couple hundred of such juniors revisiting these pegmatites, finding which ones are 5 million plus tons and grading at least 1% lithium dioxide. And this is going to be where you have many winners come, and there'll be small to medium-sized deposits feeding central concentrate processing facilities and ultimately supplying the gigafactories that make the batteries and then sell them on to the car makers. Or in the case of Tesla, they own their own gigafactory. And this is important because pegmatites are relatively simple deposits. It's something that the junior can tackle and push through the permitting cycle. And for this younger audience, they care more about the future than people such as myself, who, the boomers and people older than boomers, who are not going to be around to witness everything that goes wrong if nothing is done to decarbonize the global economy. So when they come into this space, they'll end up learning how it works, and they will also be able to feel good about it, because even if their stock that they pick doesn't end up going a 10, 20 bagger, they're part of this collective process which will deliver those future small to medium-sized lithium mines that will take care of this future lithium demand need. And this will map to all the other metals too over time. And it's a wonderful gateway for bringing new audiences into this sector. And Canada, of course, is a place that's seen an awful lot of exploration. There are no big, giant, world-class deposits sticking out of the ground anymore left to be found. Everything is more subtle. World-class deposits can still be found, but they're going to be deeper. And the majors, they have really no idea where to begin. They'll watch all this, and as the juniors start delivering discoveries, well, then they'll move in and take them out and develop the the bigger and better deposits. But to close off this question, Crescat Capital published a monthly newsletter in late April, where they have several important, there's about 100 or so graphics in it, but there's a half dozen which are really, really important, which illustrate how the major mining companies have cut back on CapEx investment and how the whole sort of commodity producer sector is like a fraction. For example, the total market cap was 117 trillion, and the resource producers, not including the energy producers, they were only $3 trillion market cap. So an important point is that when this money starts being freed up as it's liquidated from crypto and Tesla and Amazon and all that, it won't take much moving into the junior resource sector to move this group up. And normally, it's the big producers that go up first and the juniors who come last. In this case, I think the juniors are going to wake up and end up leading the charge. So even if we're in this lousy economy and in a generalized bear market, there's going to be this sectoral uptrend in the resource juniors as they get mobilized to find those small to medium-sized deposits to replace the big world-class ones that the majors are no longer looking for or bothering to push into the development pipeline. And I'll have the link to the Crescat webpage available in the blog that's associated with this Kaiser Watch episode for those who want to check out these excellent graphics.
Verde Agritech released its updated prefeasibility study this week. What does it say about where the stock price is headed?
Well, I think it could potentially go to the moon. Except, again, unlike a winner-take-all widget-type story, there is a finite limit. What they mapped out was 3 scenarios, what the NPV, after-tax NPV, is for those 3 scenarios. Right now, they have 600,000 ton per annum capacity installed. We're going to have 1.2 million tons per annum in Plant 2 operational sometime in the third quarter. And by the end of the year, they'll have doubled that to 2.4 million for a total of 3 million tons per annum. But they're working on starting in 2023 constructing a 10 million ton per annum plant. And they've now published the numbers. They haven't yet published a technical report, and that's something everybody's going to be waiting for to see how they move these numbers through time. And it came up with a 2.9 billion NPV just for K Forte production, not including the backs where they add sulfur and other micronutrients to it. And at the current exchange rate of about $1.28 Canadian for US, that translates into 3.7 billion Canadian, which with the 54 million or so shares outstanding, that's $68 share net present value just for the 10 million ton per annum plant 3 scenario. And if you add in the micronutrients growth potential, that jumps up to $94 per share. So this is in addition to what producing 3 million tons per annum of K Forte is going to do, which is all in place now. And there's 2 important things. The CapEx for this is only 53 million US, and they expect to pay that from the cash flow from the 3 million ton per annum that's happening. But here's the kicker. These numbers are based on $369 per ton KCL. So they priced their K Forte as a function of the KCL price after adjusting the fact that it takes 6 times as much K Forte to apply. But the actual price for KCL right now is 3 times higher. And although the Russians are managing to ship potash to Brazil, the problem is really not going to get better. And the Russians are being allowed to do this by the Americans because the hunger problem that's coming, if the Russian and Belarusian potash supply becomes unavailable for the rest of the world, this becomes a humanitarian crisis which is worse than the humanitarian crisis that's unfolding in the Ukraine right now. And so we get this price range, $68.94 as a potential valuation for Verde Agritech. But then they also did the 23 million ton per year scenario, expanding to it. And that doesn't yet require the rail spurs and that they can still move everything by car and truck. And there that NPV is 5.8 billion US and 7.95 with all the supplements included. And in Canadian dollar terms, that's 137 to 188. And since I'm going to pretend I'm one of those jitsu knife salesmen, that's not all. When they expand that to 50 million tons per year, we end up talking about a $220 to $320 a share price range. So the upside potential for Verde Agritech is extraordinary for a junior. Now, it's not all going to happen right away because we still need to see over time that indeed the farmers are willing to adopt K Forte as an alternative source of potash. So that's why you haven't seen the stock jump into the $50 to $100 range. But as this crisis unfolds through the rest of this year, you will see more and more farmers adopt this. They will be successful. Prices for agricultural goods are going to be sky high. They are going to make money. And all of this expanded usage, this is going to really convince the market that this is a valid substitute for traditional potassium chloride.
John, thank you so much for the update.
You're welcome, Jim.
We've been talking with John Kaiser. I'm Jim Goddard. Comments made on Kaiser Watch are an expression of opinion only and should not be construed in any manner whatsoever as a recommendation to buy or sell any financial instrument at any time. Archived online at kaiserresearch.com.